I heard a funny story that you got swarmed by a bunch of merger arb funds like you were Taylor Swift showing up to an earnings call.
We announced 2 public company acquisitions within the same month. I was at this Barclays conference in New York, and before you know it, there was like 20 people just kind of huddled around the stage as I was exiting. And my IR leader literally had to step in and separate them away from, say, Brian's got his next call or whatever.
You can leave Salesforce, but you can't leave your mortgage. That's got to be one of the better SaaS analogies we've heard, Brian.
On a weekly basis, we reforecast the entire business every single week.
Every week?
Every single week.
I would argue that attracting capital is the highest enterprise sale.
I love that. I absolutely
I just
love
made it up.
Our job is not to know exactly what the market is going to do. Our job is to plan for what the market gives us. You get a lot of oh yeah, totally.
That's such a smart
for sure.
on-ramp. Thank you for that tip. Wow. People are nodding their head in the car right now like, yep. Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast, where today's guest is Brian Brown, CFO of Rocket, a company that turned one of the most painful consumer experiences into something you can do on your phone in your pajamas. Rocket isn't just a mortgage company with great brand recall. They're a full-stack fintech with a customer base the size of a small country and a business model that's a lot more interesting than most people realize. Brian's got range. He's led M&A deals with 2 public companies in the exact same month, turned recapture rate into a competitive weapon, and still somehow finds time to reforecast the business every time Jerome Powell sneezes. He's also refreshingly honest about not being the sharpest accountant in the room, which is probably why he's so good at storytelling and strategy. We get into how Rocket thinks about long-tail monetization, the hidden power of mortgage servicing, and what it's like to be swarmed by merger arb funds when you show up at Barclays with a headline deal. If you've ever wondered what a mortgage company could teach you about SaaS metrics, brand awareness, or how to build a finance team that thinks like consultants, this one's for you. All this and much, much more after a short word from our sponsors. Are you running a small or mid-sized business? Then you need more than spreadsheets or basic tools. You need Sage Intacct, the all-in-one cloud platform for accounting, ERP, and financial management. It's built for businesses like yours across industries like retail, financial services, logistics, tech, professional services, and more. Sage Intacct outperforms QuickBooks, beats NetSuite on flexibility, and delivers fast ROI, up to 250% with payback in under 6 months. Rated #1 in customer satisfaction for 8 straight years. That's not luck, folks. It's Sage Intacct. Check out the Sage Intacct financial management platform using the link in the show notes below and take control of your growth. This episode of Run the Numbers is brought to you by Mercury, business banking for founders and finance pros who want their financial stack to actually work together. Now, I don't plug tools I don't know or intimately use. I've been a Mercury customer for a couple of years now. In fact, I showed the Mercury dashboard to their CFO, Daniel Kang, from their finance team right before we hit record on this episode. It felt like a full circle moment. And what I love most is that Mercury isn't just banking, it's operational confidence. I can send a wire to a podcast editor, I can check capital balances, and I can approve a payment for a freelancer who helped me with a tech stack report, all without bouncing across tabs or praying a PDF exported correctly. Mercury's making a bet on builders. Whether you're issuing your first invoice or wiring 7 figures for a warehouse build-out, it's banking that scales with your ambition. Visit Mercury.com to apply online in minutes and see why over 200,000, entrepreneurs choose Mercury to run their business finances smarter. Here comes my banking voice. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group, Column NA, Evolve Bank and Trust, members FDIC. The IO card is issued by Patriot Bank, members FDIC, pursuant to a license from MasterCard. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI-powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit RightRev.com to see how we make complex revenue simple. That's RightRev.com, where revenue recognition actually works. Brian, thank you so much for joining me on the podcast.
It's great to see you, CJ. Happy to be here. Thanks for inviting me. You got another fan. I've become a subscriber recently and been enjoying it a lot.
Well, I'm a huge fan of Rocket Mortgage. My only social media app in life right now is Redfin. Me and my wife just swap houses back and forth. So this is a really cool podcast for me to do.
Absolutely. Well, I hope we get to talk about that. I'm also a very early and frequent user of Redfin myself, as you could appreciate.
Yeah, and just at the top, quick shout out to Jonathan Mariner, our mutual friend. I know that he's an advisor for Rocket Mortgage. That guy is a true renaissance man. Like he's truly an interesting cat.
He's the best. And the only thing that's unfortunate is I have to follow him up on this podcast because I got a chance to listen to his episode and I was like, man, he's really cool and interesting. I don't know if I'll be that cool or interesting, but he's a brilliant guy that we're very happy to call a board member and personal mentor and friend to me as well.
So if anybody's interested in that episode with Jonathan, we go deep into the business of sports. He's a former CFO of the MLB. So after you listen to this groundbreaking episode with Brian, you can tune in there. Brian, from the top, I think a lot of us know the Rocket Mortgage name, but not everybody understands how the company makes money, like how the business works. Maybe you could humor me with giving me the 30-second overview of how Rocket Mortgage monetizes.
Yeah, absolutely. My favorite place to start, as you can probably imagine.
Yeah.
But yeah, I mean, so look, I came to Rocket 11 years ago and it's changed a lot. Actually, at the time, it was Quicken Loans. We were founded by Dan Gilbert. He's our founder and chairman. To this day, he still sits on the board and is really active in the business. And you might know him from other ventures like the Cleveland Cavaliers, and he's big into real estate in the Midwest as well, particularly in Detroit. But essentially, when we look at the business of home ownership, which is where we operate, it's very fragmented. And you mentioned Redfin at the beginning. And if you think about how a consumer goes about buying and selling a home, just like right off the top of my head, CJ, you're going to interact with a lot of companies. You're going to probably like a Redfin, you're going to start your search online. You're going to then need to find a real estate agent. You're going to need to get financing. There's this whole thing called like title and closing and title insurance, which most people still to this day don't even really understand. And there's a lot of other companies like homeowners insurance companies and inspections and appraisals. So I think I just named 7 without even really thinking about it. Traditionally, those 7 companies have all been separate and distinct entities, so to speak. So if you think about yourself as a potential home buyer, or even if you own a home, you're selling it, you want to get another home, a bigger home perhaps, you have to interact with all those different companies. Well, the problem with that is just like you would expect, all of them have different customer journeys and experiences, different ways of acquiring clients, different ways of interacting with clients, chat, email, digital, calls, phone calls, and they all have disparate processes. They don't even, in most cases, share data with each other across those ecosystems. Enter Rocket. We own all of those assets that I just mentioned. And what that allows us to do is a couple things. Maybe the first, most important part is it allows us to curate and customize that experience for that consumer across all of those different, very important consumer touch points. So it removes friction. It allows you to interact with clients through the same voice and messaging and technology. That in itself, if you've ever bought a home, is like, wow, pretty impressive. But it also allows us to do another thing. This is a financial podcast, and a lot of us are financial people. If you think about all those companies being separate companies, one of the challenges you have is they all have separate overhead. They all have separate functions. locations. They all have facilities and employees performing similar things. And they have to make money and they have to cover those costs. So they all have to charge the consumer money. Well, if you're Rocket and you own all of those assets, you have this amazing ability to consolidate the client experiences, but also the cost structure of it. And to the extent we can provide those services efficiently and effectively across those different platforms, it allows us to do something that I would argue no one else in the space can do, which is offer a consumer value proposition that is much different than what you'd be able to find elsewhere, because no one else has all of those different assets across those different platforms. So we can offer a consumer things like lower rates or better fees and faster closing times because we own all of that technology across those different assets. So I think, CJ, in a nutshell, I'd say it's the consolidation of assets that have been disparate, frankly speaking, and making the consumer experience much, much better and more efficient, and allowing us to pass along some of those cost savings to the consumer really is a strong differentiator when I think about Rocket.
It's funny you mentioned title insurance, Brian. I've purchased 2 homes now, and I still, as even a CFO, like I still don't understand it. And that's just like emblematic of the home buying experience. It's the largest purchase you're making in your life, but it's so opaque and it's so fragmented.
I think that's so true. By the way, you don't even find out about it till it's time to get it. It's like, okay, now you need title insurance, and you're like, cool, where would I get that?
Where would I procure that?
Yeah, where would I procure that? Yeah, no, don't quiz me on title insurance now, because that's not that's my area of expertise either. But you're right. It is such a good way to describe the home ownership process. It's like every step of the process, you find out there's another step, and you usually find out from a different person at a different company with sort of a different value proposition. And bring it all together is something that is a big differentiator.
So I mentioned it already. You're a household name, which I'm now just discovering live on this podcast. It's a terrible dad pun because you're in the business houses.
I see. I got it. I see what you did there.
Can you speak to the intentionality behind the brand awareness, especially compared to the typical lack of visibility of other players in the space? Because I mean, you were saying those 7 different layers. Like, I don't really know any other companies like off the top of my head.
Yeah, it's a great question. I have to go back again to our founder and chairman, Dan, because this is something he believed in back in the day. As I mentioned, we were Quicken Loans when I joined the company, which at that time was like the biggest, to your point, biggest brand in the space. But I think, CJ, the way I'd start is like maybe trying to explain why I think companies in my space don't invest in brand. And I think they don't invest in brand because if you think about the frequency of a mortgage transaction, it's like, there's 5 to 10 years, depending, in between each time you're going to transact. Most US consumers don't buy a home every single year. That's crazy, right? You buy a home because you're planning to stay there and invest in it, maybe grow your family and live your life. So I think most companies just couldn't get over the hump that, hey, why would I invest in brand, right? Why would I try to be a household name when, I'm not going to talk to that client perhaps for another 10 years? And I could see why that would make sense from their perspective. But we've really tried to flip that on its head, because the other aspect that's important is, yes, I might not buy another home for 8 years, but when I do, man, that's a really, really big moment in my life. And I want to do it with someone that I trust. I want to know that there's confidence there, because for most people, it's going to be the biggest financial transaction of their lifetime. And by the way, probably worth saying, and you probably already know this, CJ, but owning a home is the biggest differentiator of wealth in this country. Whether you own a home or not is the biggest differentiator. So it's a super, super important transaction. And why would you as a consumer want to do it by some company? You wouldn't. You want to go with someone you trust. So we realized that very early on, that yes, there's a lot of time in between the transactions, but it is such a big decision that consumers want to do it with someone they know and they trust and they have confidence in. And particularly, they believe they're getting really good value. So we figured that out early on. But the other thing we figured out is about this relationship with the consumer doesn't necessarily have to be once every 8 to 10 years. And the reason for that is, we might only buy a home once every 8 to 10 years, but you have to make your mortgage payment every single month. And what a good way to start building relationship with a client after they've done that mortgage, just by collecting their payment and getting to know them a little bit better.
That's so true. And the more that I think about it, it's not a recurring market in the sense of like a SaaS payment. Well, it is in the payment cadence that you make it, but like I'm not in the market every single year for like a new ERP or something, right? But at some point or another, you do need to switch things up as you scale. In the home market, to your point, Brian, the customers, they do come back. Like you just don't know when. You don't know if it's going to be 10 years, 30 years, could be 2 years if they have to change for work or something like that.
Yeah, it's such a good point because it's the only business I can think of where you get the home, right? You obtain financing, which is the mortgage, and then you make your monthly payment, usually to the person that did the loan, not all the time, because a lot of mortgage companies sell that, what we call mortgage servicing right, the right to collect the payment. They sell it to someone else. We don't do that. We keep it for the exact reason you just mentioned, which is like, what a great way to build a relationship. But I can't think of another business where like you can choose a lot of things in life. You can't choose who you make your mortgage payment to. In fact, the only way you have any choice then is to get another mortgage. So this mortgage servicing aspect is really important if you know how to do it well and if you can use it to build a relationship with a client. And most companies that started doing that really started doing it to collect the payment and pass it along to, which is like the bondholders, the people that ultimately buy most of the mortgages in the United States. We call them mortgage-backed securities. You know, someone has to collect those payments and remit them to bondholders. So most companies that started this were like, hey, like, let's just do it super cheap, because the cheaper we do it, the more of that revenue we can hold back. And there's nothing wrong with that. And Rocket does a pretty good job of that too. But we were like, to your point, it's like, it's really hard to leave Salesforce if you're using ERP. You could do it. It's hard to do. But we're like, hey, these clients actually aren't going anywhere, at least until they get their next mortgage. So let's build this platform differently. Let's actually make it a marketing and CRM platform and use it as a way to get to know our clients even better so that when they do that next mortgage, they do it with Rocket. Yes, collecting their payments and giving it to bondholders, that's important. You have to do that. There's regulations around it. But what's so much more important is having your brand, your team member base, your experience out there for the clients to see, because then 8 years later, when they do need to get another mortgage, who are they going to call? Well, they're going to call the company that's provided them a great service for 8 years.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Did you know that around 40% of manually processed invoices contain errors, missing data, bad codes, duplicates? And those mistakes don't just slow your finance team down, they cost you money. That's why global finance automation matters. It's not just about saving time, it's about keeping your business safe from costly errors. And that's exactly what Tipalti does. Tipalti is the serious AP solution for serious business. Tipalti automates the end-to-end payables process, handling everything from onboarding suppliers to global payouts, all so your finance team can breathe again. More than 5,000, of the world's most ambitious businesses already rely on Tipalti to make payments in over 200 countries and 120 currencies. With baked-in security and tax compliance, Tipalti gives you the confidence to scale globally without adding extra finance headcount. Give your finance team their time back. Don't let bad invoices drain good money. Visit Tipalti.com/run-the-numbers. Tipalti.com/run-the-numbers. Tipalti, serious AP for serious business. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. And so I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com, aleph.com/run. Tell them CJ sent you. A messy or missing cap table might not just slow you down, it could cost you your next fundraising round. VCs get flooded with pitches, and if your equity is confusing or missing, they'll move on fast. Fidelity Private Shares is an all-in-one equity management platform that helps you maintain a clean cap table, an organized data room, and a clear equity story. Schedule a demo at fidelityprivateshares.com. Mention Mostly Metrics and get 20% off. You can leave Salesforce, but you can't leave your mortgage. That's got to be one of the better SaaS analogies we've heard, Brian.
That is, it's so well said and unfortunately true.
Just to play it back for listeners, like mortgage servicing, it's definitely underappreciated as a touch point in the consumer model. Do you think that other companies can think about monetizing the long tail of customer relationships more thoughtfully by learning from this model?
Yeah, I really think they can, because if you think about this, why should you focus on it, or why does it work? Well, it works because you have this monthly touch point with the client. And in a lot of ways, I think there's companies out there that they have these touch points and they don't know how to make them special, or they don't know how to make them unique. And part of the way to do that is just make them really easy, but also don't lose sight of the opportunity to get in front of the client when they have a problem. Another thing servicers are responsible for is some people do escrow. So they put their taxes and insurance in escrow, right? And that helps smooth out the payments. It's actually a really good choice for a lot of consumers. But then every year that escrow gets reassessed, and the world we live in today, most of the time taxes and insurance are only going in one direction, up, which means that your mortgage payment goes up. Now that can be a very friction-filled process for a consumer, and it's our responsibility to help them through it. But again, to kind of flip that on its head, it can also be an opportunity to help that consumer through something which could be very difficult for them, and do it with empathy and do it in a way that builds confidence and trust. And then that time comes up again where they want to do that next mortgage, and they're going to think back to that time. Hey, remember when my taxes went up and Rocket helped me understand the why and helped me understand how to reset my payments in an efficient way so I can afford it? That is like this one example of a brilliant opportunity to take advantage of. Again, there's a lot of companies out there who just think, how can I get this client off the phone the fastest? Or how can I get on with the next cash flow I need to collect, or how can I cut expenses in that area? While all those things are important, I'd argue the opportunity to have a live, empathetic interaction with the client is something that, if you take seriously, will really help recurring revenue in the future.
And I think it all plays out in the metrics, right? And one that you had thrown at me when we were preparing for the show is recapture rate. And I love this one. Can you break down that measurement?
Sure. So one of the things, CJ, when I first got in this space, and I had done some consulting and other work at Ernst & Young, so I'd seen some, companies and how they operate. You and I talked a little bit about SaaS models, and it's like, what's the renewal rate of a Salesforce contract? I actually have no idea. Don't quote me on this, but it's got to be like 99.9% because it's so
Pretty
hard.
high.
Pretty high, right? Once you're on for a while. Well, when you look at mortgage companies, like you said, they do have this sort of subscription-like model, which is like the servicing and collecting those cash flows. We just said that the clients can't actually leave. But when I got to this industry and business, one thing it was like a stat I couldn't believe was that, and it's still true today, that 80% of consumers, when they get their next mortgage, will choose a different mortgage company than the one before that. So 80% will use a different mortgage company on their second mortgage.
Essentially churn, 80%.
80% churn, exactly. 80% will intentionally choose to not use that company before. Now, at Rocket, that is exactly in the inverse, meaning about 85% of our clients will return for that second mortgage and then beyond. In fact, we have clients in our portfolio that we've done 8 to 10 mortgages for. They just keep coming back because why not? We provide that really good service. But that just goes to show you how broken the mortgage and finance and home ownership space is when 80% of the time, most people are saying that previous experience was was so bad, I'm going to go test my luck with someone else, right? Like it can't get worse than that. And versus Rocket, 85% of the time clients are saying, oh, I'd like more of that. Thank you very much. Because, not only did you do my first mortgage really well, but you continue to take care of me through the monthly payments and the servicing process. And when I had trouble, you actually picked up the phone. You had someone there to walk me through it, where you had great digital experiences. That was like shocking to me. And I'm proud to say that that's something we identified very early on at Rocket and Quicken Loans before that. And again, it just comes back to we built it completely different. We built it upside down and we said, hey, this isn't actually a collecting of a payment model. This is actually a CRM, get to know your client, provide a great experience model, and you can flip that on its head. And you can imagine the last thing I'll add there is, one of the hard parts about doing mortgages and being in the home ownership space is acquiring the client. The cost of acquisition is very high, because if you think about a client who's out there in market shopping for a home, particularly one that has high intent, everyone wants to acquire that client. Everyone. That's like the hottest deal. On the realtors want to, title companies, appraisal companies, mortgage companies, brokerages, they all are fighting for that same client. But and it's expensive, but if you're Rocket and 85% of the time they come back to you, it results in a really nice lower cost of acquisition model, more like that Salesforce subscription model.
And I think you noticed early on, similar to Salesforce, the best customer is the one you already have.
Exactly. And they already know you and they already trust you. We always say the best, when we say like, why is your recapture so good, Brian? And just tell me the real deal. Like, let's get to the real talk, like an investor meeting. And I'm like, it's really easy. Just do the first transaction really well. It's almost that simple, right? Don't screw up the first mortgage. Number one, do that one really well, and then continue to take care of them for the life of that client. It's I'm sure harder than that to actually execute, but it is almost that simple.
And it's playing long-term games with long-term people, right? Like you understand that this isn't, I don't know, a company that you hope is going to be around in a couple of years. Like if it's a family in the US who's doing pretty well, they're probably going to go through a couple different houses. And it kind of plays out in the LTV to CAC that you seem to understand pretty well. So you understand the lifetime value of acquiring that customer. And if you can have multiple hits with the same one, like it plays out in spades.
That's so true. And I'm glad you brought that up. That whole concept of LTV to CAC hasn't even been a thing until Rocket entered the home buying and home ownership space. People didn't even talk about it. They just, because remember, 80% of the time they knew they were going to lose that client. They didn't. The LTV was just the first transaction. There was never another. It was the easiest LTV calculation in the world. It was like, what am I going to earn on this transaction? The rest is zero, right? So now it's like, no, now we can say, no, we're going to help clients 2, 3, 4 times during their lifetime, perhaps in home buying, but also remember that the beauty of working with Rocket is if and when rates do decrease, you got in that mortgage at 7%, which is, frankly speaking, a lot of consumers over the past couple of years are sitting on 7% mortgages. And even today, as I get ready for this podcast, mortgages rates are, you can get as low as 6 or even a high 5 handle on that. We're here to also tell you, hey, guess what? Rates have gone down. You can save money by refinancing. How would you like to lower your monthly payment? Again, without that relationship, that servicing relationship, that CRM, where we have your back and we're monitoring your situation every day, like good luck. You might wake up and think about that yourself someday, but I'd argue most consumers have better things to do with their lives than worry about their mortgage rates. With Rocket, you can trust us to worry about that for you. And if and when you can save money, we're happy to, give you a call or walk you through it. That adds to the LTV as well. And again, to your point, my cost of acquisition is very low on that because I'm already acquired that a client and I'm already working with that client in my ecosystem.
Something I've noticed that Rocket does really well, even like when I was preparing to buy my first home, you look online, there's tons of information out there that Rocket will provide on like buying your first home and the different costs that come up along the way. And it's not necessarily like saying like work with us right away. It's just trying to educate the person. And I talk with a lot of advertisers on this podcast now, Brian, and I always say educational content is actually the best advertising content because it's just giving value to somebody. And like down the road, you will be in what I call the consideration set for somebody to make a purchase. But you have to win them over to say like, they're giving something of value to me and they're trying to make me better at whatever task I'm trying to achieve.
Especially in a transaction like this, because we just talked about it's for most people, it's the largest asset they're ever going to own. And it probably will determine when they're going to retire, right? Like,
Great point.
that's the biggest place people have savings. It's not talked about very much, but the equity in your home is most people's biggest tool for retirement. So you said it really well. And by the way, that's why CJ Rocket is number one and does so well with first-time home buyers, because you have to meet first-time home buyers where they are. And some people, wait longer to buy homes, and they might be more financially educated or savvy, so to speak. A lot of people aren't and are, getting started on that journey very early on in their career. Another thing you have to consider in today is income streams look different, right? Not everyone has the traditional W-2 full-time job. Some people are like yourself, are doing cool podcasting, and you have different forms of income that come in for that. And understanding those income sources and how to use them to get clients qualified, particularly first-time home buyers, is something that if you want to be good at it, you said it well, you have to understand what the client's at, but provide them information to understand where you're coming from, make really good financial decisions. Because by the way, it's not good for them, nor is it good for Rocket if they can't actually afford that home, even if they can qualify. So helping a client through that journey, I couldn't agree with you more, is probably one of the most important parts.
I want to transition to talk about financial storytelling for a bit. And you've said that you're not even close to the best finance or accounting person on your team, which I thought was very humble of you. But it seems like you found your sweet spot in strategy and storytelling. So I'm curious, what makes a financial story actually compelling to investors on the other end?
I'm hoping this isn't like a job and you're like, oh, this guy's not even good at finance. No. No, I'm just kidding. But no, I think it's true. I mean, number one, I am not the best at, if you think about the traditional verticals in finance, we're a large cap public company. There's FP&A, there's accounting, there's treasury, there's procurement. In my world, there's internal audit, and on and on. There's many more. Tax comes to mind. And I'll be the first to admit, CJ, that I'm not the best in any of those, period. But two things I would say. One is it's all about building great teams, especially at this size and scale. And, you have to have experts in those areas. But kind of goes back to what you suggested. I actually think that all of those verticals in finance come together to do one thing, and that's present a really good financial story to your shareholders or stakeholders, should I say. In some cases, those might be internal, your own employees, or we call them team members, care about that. Of course, your board of directors and CEO, they're very keen to understand the financial story of the organization. And then maybe most importantly are your shareholders, your external shareholders. And so you need all of those functions to be working well to craft a good story. But to answer your question directly, what makes a good financial story? Well, I'd say the same thing that makes a good story in general in life. I'm a big reader, right? First of all, the narrative is important, and how you set it up matters. I'd say two perfectly qualified, good CFOs could approach an investor with the exact same set of facts and data. Like, you can't change the financials. The financials are what they are. Maybe you're talking about a quarter performance, and maybe it went well, maybe it didn't. But I'd argue two different CFOs could approach the same investor with the same facts and information, and the ending result of that could be different outcomes because of how well they told the story. Because finance today is not just about the numbers. It's actually about explaining the numbers in a way that's compelling to investors and shareholders. So just like any good story, the setup matters. How much about the company does this particular audience member, in my world, mostly investors, know? If they've been invested in Rocket stock for quite a long time, I'm going to skip to the point, right? They get the story. But if they're brand new to the story, I have to do, CJ, kind of what you and I just did, which is I have to tell the story of why we're so different and why you should be excited to be here meeting with us. But then, like any good story, there has to be a point. There has to be a climax to the story. Like, what is the real point? And what is your pitch? In a few seconds, in a few minutes, tell me why I'm here to talk to you and why I should put my hard-earned capital into this business. And then you have to end with a strong conclusion. I think, in my line of work, I hate to say it, but part of being a CFO these days, particularly in public companies, is being good at sales. And that, I think, scares some CFOs to say that out loud, because let's face it, CJ, most of us didn't come from that background or think we were signing up for that when we got this job. But I think you have to be good at it, because you have to ultimately attract capital, and people that are willing to give you capital are usually people that need to be able to trust you. They need to understand your background. They need to understand what your company's about. And it's usually a pretty big decision point, because that means they're choosing to invest in you or your company when they could invest in something else. They have to put capital to work. So I look at it like, hey, there are a lot of things a CFO has to be good at, but I'd argue being an expert in any one vertical, while it can be very helpful, and I don't discourage people from doing it, isn't actually the most important thing.
I would argue that attracting capital is the highest enterprise sale.
I love that. I absolutely
I just
love
made it up, but I think
Yeah.
it's
I literally love that. That is great. Well, think about one of the things I talk about with my internal team is, if you're good at storytelling, if you're good at sales, so to speak, you're probably going to be successful. I'm just generally going to say in life, at least through a career lens, you're probably going to be pretty good at what you do. But I would say, you said it well, what differentiates this type of sales is really who is the counterparty, right? Who's on the other side? They're usually fairly sophisticated, right? They don't get to those jobs. If you're a PM at T. Rowe Price or Fidelity, you're like, yeah, you're pretty good.
Yeah.
You don't get many bad investments, or you don't hit your mark every quarter, you're probably not in that role very long. So I like how you said it. It is a sophisticated sales position in some ways, because if people are going to give you what's most important to them, which is their capitals, i.e. money, they're making a pretty big bet in your company.
Do you think that finance people are generally better salespeople than we give ourselves credit for?
I actually do. And you know why? Because they have, I think one thing about being good in sales is the person who has the most data and information usually wins. Not always, because there are good salespeople that can get around that. But if you use our talk track around investors and things that we spend our time on, they bring a lot of data and information too. But finance people generally have the advantage of access to data and information. Maybe access isn't the right word, actually, because I'd argue in business, a lot of people have access to that information. But I think a special skill of a finance professional is not only you know where to find the data, you know how to read the data, but you also know how to interpret the data. And I think that's a big thing that gets missed sometimes.
Yeah. And I think it's, how do you position the data points as characters in the story, not the entire story? And just reflecting on how you think about storytelling, Brian, it sounds like you have to position it differently, whether you're talking to an internal audience versus an external audience that's been a shareholder for 10 years.
Yeah, that's right. It kind of, communications 101 starts with know your audience, right? And they're not all created equally. And if you think they're created equally and you use the same talk track each time, I don't think you'll be as successful.
This may be a weird question, but something that I've always felt a bit vulnerable about is repeating myself over and over again, because I have to hear it, right? So I'm like, oh, you've said this before. As a CFO of a large cap company, I guess, how often do you repeat the story? And then do you get comfortable in the fact that you know you're repeating it, but it's the right thing to do?
Yeah, it's a good question. I'll tell you maybe a little secret, if you don't mind, between you, me, and our closest friends here. But yes, you do have to repeat yourself, because you're just, you're speaking at different conferences, you're speaking at different investors. To your point, you're talking to team members. Some of that you do. You just do. You have to. It's like repetition, is good, generally speaking. But I also think a good storyteller and a good CFO in a lot of ways is also sort of testing a little bit new material.
Yeah.
Along the
Say
way.
more.
You want to be consistent. There's no question about it. But I know myself personally, if I'm going to get in front of different investor groups, a lot of times at these public company conferences, you'll meet with 8 to 10 different groups of investors in, maybe an 8 to 10 hour day, which you're like, oh, that was exactly what I wanted to sign up for. But look, you do have to be repetitive because it's important to make sure the same facts and information is getting out, no question. But going back to that storytelling angle, I think it's also important to, try maybe say it a little bit different to the next investor. And there's lots of visual and audible clues you get back. And I think you're constantly in this feedback loop where you're like, okay, you know what? I got a couple head nods there, a couple of smiles. Maybe that analogy worked better than the analogy that I used before. Maybe the example in our world too, you think about the things we have access to in our business. We try to use examples to make our points, right? Don't take my word for it. Let me translate that to a financial number that I realized those financial number examples, I have a whole host of them that I could choose from. Some will work better than others, even if the impact is relatively the same. They just might resonate with people. So I would say repetition is king when it comes to investors, but I would also say, just for what it's worth, test some things out and try it differently, both in your internal stakeholders, but your external stakeholders too, because different messages resonate with different investors.
I was at a security company that would check for vulnerabilities in your code, and I was running IR, and I remember in some meetings I'd say, we're kind of like Grammarly for your code, and then in other ones I'd say, we're kind of like spell check for your code. And I'd be like, I think I'm like a bad stand-up comedian who's like trying to like test his joke before he brings them out to the prime time.
I thought what you were going to say, CJ, is before you met with that investor, you looked at the stocks they owned or the companies they owned and you used those examples.
Oh, see, that would have been the real inside bait. That's the real Jedi move right there.
That's a little pro tip. We always take a quick peek of what else they own, and to the extent you can make comparisons there, you get a lot of like, oh yeah, totally.
That's such a smart
for sure.
on-ramp. Thank you for that tip. Wow. People are nodding their head in the car right now like, yep, right. Well, let's talk about M&A because you've done a number of deals at Rocket, including two, I think I have this right, Brian, two public company acquisitions in the same month. Is that right?
Yeah, crazy to say, but very true.
And so what makes public to public deals different and I guess harder than private ones?
We've done both, and there's probably pros and cons to both public and private. A couple things that I think stand out that make it different. If I had to pick one thing, it's just the fact that if it's public to public, you're dealing with two different board of directors, right? Two different management teams, which you could argue is true in private. But like if you're a public company and you're selling, it's a very, very big deal. It's a huge decision to make. And it is for any company, by the way, private or public. But I'd say the stakes are even higher when it's public because you're so worried about leaks. You're so worried about just things getting out there. There's this whole like material, non-public information stuff, so being buttoned up on confidentiality. So there's definitely some aspects of the deal that I would say are very heightened when it's public to watch out for. But fundamentally, it's still about, does the industrial logic make sense, right? Do the financials pencil out? One nice thing about public to public deals is you start with a really good set of financials, right? Part of the challenge in private deals is like getting to the financials, depending on the size of the company. It's like, are the financials even accurate? Can we even trust them? Like you find yourself re-auditing like auditors work and doing a lot of that. With public company deals, most of the time, not in all cases, you kind of take for granted that their publicly stated financials are a really good starting point. But the thing I would say is it still comes back to the relationship too. Most companies don't have to sell their company. Some want to, and that was like, part of their business strategy is like grow and then sell. Some are selling because maybe their financials aren't working out as well, and maybe that's a good option for them. But they still get a choice. Even if they don't get a choice in terms of whether they have to sell, a lot of them get a choice in who they sell to. So those relationships, whether it's public or private, are extremely important. So investing in the management teams, working together, getting to know each other, the board of directors, making sure they're on board and that they're getting the right, if both boards of directors are getting the right information, controlling that information flow so the timing is right. Those things stand out, particularly in public companies, but I'd argue are probably important in private deals too.
Okay, so the financials are cleaner. That's definitely an underrated aspect to it. That's nice, easier to do some diligence. But it sounds like the communication takes a lot more forethought, and there are more people that you have to please in each boardroom.
That's right, because it's the board, and then remember, at the end of the day, if you're a public company, the shareholders have to vote too. So it kind of comes back to a little bit of that storytelling aspect, like the numbers have to pencil out, the industrial logic has to work. work. Then you got to get the management teams to sign off. Then you got to get the board of directors to sign off. But on top of that, it's ultimately going to come in most deals to a shareholder vote, and they're going to get the ultimate say so beyond the board of directors. So you better be taking or doing rather having a convincing argument for them, both in terms of the financials and how the two companies are going to work together. There's no doubt about it.
Because they become your shareholders then.
Exactly. The day that deal closes, whether they like it or not, by the way, those shares convert to your shares. So in our case, as the acquiring company, you actually have a big job to do that you rightfully so bring up. You have, one thing you could do, which I wouldn't argue is a good thing. You could just be like, hey, hope your shareholders, your existing shareholders increase their positions, right? Because, there could be selling shareholders coming to the table. And you should do that, by the way. I definitely encourage after the deal is announced to do a lot of shareholder outreach and make sure your shareholders understand the transaction and the economics and spend some time with them walking it through. But you have a whole new set, to your point, CJ, of shareholders that are now your shareholders, whether they want to be or not, and whether you want them to be or not. So spending time getting to know them and what's important to them and in understanding their investment thesis in the company you're buying and how hopefully that's only going to get accelerated through the acquisition is an important part of the puzzle.
Yeah, and it's so important to know because you're in a public market like we established before. You're bringing all these other existing shareholders on board. You want to know how it's going to impact the combined entity and the liquidity there.
Yeah, it's so true.
So I pointed out before that I'm a Redfin power user. What was the investment thesis behind that acquisition? And if I'm not mistaken, you can correct me if I'm wrong, but wasn't this deal sort of manifested years earlier?
Yeah, it's a good point. Redfin, actually, we're 2 years into, we have a new CEO, and I don't know if you can say new after 2 years, but we've been around as a company for 40 years and we're only on our third CEO. So, I think 2 years is still new, but Varun Krishna joined us from Intuit, as a matter of fact. He's an engineer and a technologist by trade and someone that I think is absolutely brilliant in the technology and consumer product space. And he was like studying mortgage and understanding how mortgages worked. And he's like, man, what a great opportunity to just build these really, long relationships with clients. And he looked at the space from a technology lens. He's like, wow, this thing is like ages old, like decades behind just modern technology. Man, this could be like such a good opportunity to take it and rebuild a lot of this stuff. So we were lucky enough that, he came to us and, we built a really good relationship. But funny enough, I was lucky enough to be part of the interview process of, selecting our next CEO. And, Varun was one of the candidates, of course, and we sat down and we were doing a little whiteboarding exercise. And I should say for the record, CJ, of course, he was my favorite by far, not even close. Get that out there right away, right?
Yep. Got it.
My now boss. But but that being said, we were doing this whiteboarding and we were talking about mortgage and the opportunity, and we were just clicking. We were like starting to really get into a good flow, and like we see the world the same. He was like, wow, I had never thought about that. And I was like, wow, the perspective you bring is great. And he brought up in that conversation, he's like, you know what? Most consumers start their search, their journey for a home online in one of these web properties, right? And I'm like, yeah, totally. Like everyone, especially everyone who's in a younger demographic, first-time home buyers, of course. But literally, if you believe the numbers of the search properties, every adult person in the United States is using one of these properties. And he's like, it seems to me that would be a great place to start building relationships with consumers, well before maybe they have really, really high intent. They're just like interested. You mentioned being a power user of Redfin. I was as well. And it's like, it's just fun. And you might not actually be, looking to move tomorrow, but if you found the right place, maybe it's your neighbor's house, maybe it's around the corner, maybe you live in a city and there's a north and south, you're in the south, but you want to be in the north. Maybe it's closer to your kid's school. Maybe, maybe you've had another kid or a life event and it's time to expand. That's where everyone spends their time. So he goes, have you ever thought about buying or merging with one of those companies? I'm like, I've thought about it a lot. Have you? And he's like, yeah, I only have one in mind. And I was like, it was one of those, like, we looked at each other. I'm like, oh, you go first. Cause I was, I'm like, At this point, I was like, it's your turn, buddy. Nice try. And he goes, I would only buy Redfin. I would only start there. And I was like, that's exactly what I was going to say. And we went through our reasons why. And the cool thing about Redfin is, one, they were one of the very first to market. Publicizing and listing on a national scale, the MLS listings has always been their bread and butter. They got an early start and they've always been product centric. So they've always thought with the end consumer in mind. Even today, they have about 50 million monthly active users, which is really, really impressive. But beyond that, we look at the quality of their metrics and their traffic and the people that use the mobile app, the people that come back more than once a day, we think as a percentage of total is some of the highest engaged consumers on search properties. But so, yeah, it started, I can say it now, I couldn't say it then. Even before Vroom technically started, we were brainstorming on how we could, partner at a minimum, maybe acquire at a maximum one of these companies that had this very valuable thing, which was millions and millions of consumers that are at least interested in homes, if not ready to buy a home.
That's such a smart top of funnel, not even top of funnel, but it's almost like the user continuum. Like how do you capture that mind share to be there when it is time?
It's a good question because that's really been one of the challenges of these, search portals has been, hey, like we know everyone's using them. The numbers speak for themselves, but you have to then figure out, like any good digital web business or mobile business, you can get the traffic. That's half the battle. But of course, over the long run, you got to figure out how to monetize it, right?
Sure.
And that's sort of what I think makes one of the things that makes Redfin different and more interesting to us is there's several different, monetization models out there. You have Zillow on one hand, you have homes.com, you have Realtor. They all kind of go at it a bit differently, and neither one is necessarily right or wrong. But what Redfin said is, I want to be vertically integrated. That's what I want to do. And I want to keep the focus really to the consumer and the real estate and mortgage transaction. And that's what made it so exciting for us. Their challenge was they just couldn't do the mortgage piece at scale, but they had the big, huge top of funnel with 50 million MAUs. And then they had a very small mortgage company and a relatively small real estate brokerage. So it was sort of like the funnel just had a very, very wide and big top and a very, very small monetization vehicle being mortgage and real estate at the bottom. And to rocket into the equation, and we literally, take that bottom part of the funnel and widen it significantly on monetization because we are the largest mortgage lender in the United States. So it's not a big leap of faith, right? If you're on the Redfin site and you're interested in a home and you want to get connected to an agent, which is how most consumers shop on the site, to then have mortgage be part of that conversation. So we've just made simple changes because we don't want to do anything to impact the traffic or the consumer experience. First and foremost, they're there to look at homes like all of us. We don't want to disrupt that. But if they get further down funnel and they're starting to demonstrate intent, like, hey, I want to see that home, or hey, I'd like to talk to a realtor. Well, the next most logical question is like, hey, do you know anything about mortgage, or is that something you can offer? So we're building that experience into the Redfin funnel so that, again, going back to our earlier conversation, we can have one vertically integrated experience for all of our consumers. And so far, it's been very successful.
That's an awesome story in vertical integration. I'm so glad it played out well. So us CFOs, we're not usually the star of the show at any sort of conference. We don't get mobbed that often. But I heard a funny story that you got swarmed by a bunch of merger arb funds at the Barclays concert, like you were Taylor Swift showing up to an earnings call. What was that like?
That was my moment, my claim to fame. Finally, I've been waiting my whole life. But no, it was funny, with these acquisitions that you mentioned, CJ, a quick fun fact, if you don't mind, is so you're right. We announced 2 public company acquisitions within the same month, literally the month of March. I'll, of course, never forget that date now. Earlier this year, 2025, we'd already done it, but we said, I wonder, when was the last time this happened? Or has this ever happened? And so we went back and researched it. I think it happened one other time. I want to say it was Pepsi, and they had bought 2 public companies. I think they were distribution companies during 2006. That was when the last time it happened. And so needless to say, we bit off a lot, and it was fun. I never want to do it again, but it was very fun. And it was definitely for all the right reasons. But so if you think about it, we announced that, and then you still got to go on with regular public company life. And public company life life, particularly for a CFO, is meeting and talking with investors, doing conferences, one-on-ones, all the regular inbound, outbound kind of things you do. So yeah, I was at this Barclays conference in New York and I didn't even really think much of it. I got my talking points ready, met with the analysts. We're going to have a good conversation. I think we did. I don't know, maybe not. And then I'm walking off the stage and we had run out of time. They had taken some audience questions and I'm walking off the stage. And before you know it, there was like 20 people just kind of huddled around the stage as I was exiting. And, of course, my first thing was like, oh, they're not here for me. I don't know what they're doing, talking to analysts. Or I was like, whoever this next presenter is must be really good. Maybe I'll try to get a seat. But little did I know at the time, no, they were there for me because these merger arbitrage funds, they essentially make bets on when and if public company transactions close. So any information or details they can get out of you could be helpful for their thesis. And they do tend to be, and no offense if any are listening, but they do tend to be rather aggressive because they essentially have a short window to gain information and place this bet. So nonetheless, I'm walking out of this thing. They're literally surrounding me like some type of, celebrity to your point. Exactly. And in my IR leader, like literally had to step in and separate them away from, say, Brian's got his next call or whatever. Now, unfortunately, CJ, it was a cool story. It wasn't, I don't know what type of questions Taylor Swift gets asked or selfies or whatever. These were not those kind. They were like, technical questions about closing the deal. But you're right. That was sort of my claim to fame, my moment in the sun, so to speak.
I'm living vicariously through you. I'm imagining you signing baseball caps.
I'll sign 10 Qs for him next week.
Well, let's talk forecasting because a lot of people are probably listening to this saying, we're in one interest rate environment now. A couple of years ago, we were in a different one. How do you forecast the business?
It's a good question because it's not easy in my world. Interest rates, things like home values, inventory. We talk about number of homes available is a big thing, buyers markets, sellers markets. All of those things have an impact on your financial performance. Now, of course, it's our job as business operators to make sure we can perform through any of those cycles and do well in any of those environments. But let's be honest, we're finance people around here. Rates matter. And how many homes are available for sale anytime? If you're in the homeownership space, it matters. More homes, better. Less homes, generally not good. Lower interest rates, better. Higher rates, not usually good, at least for our business. So I'd say the way you have to go about forecasting is a couple things: flexibility, adaptability. You really have to, we are not the type of company nor finance organization that can do the old set it and forget it model. That just frankly speaking doesn't work here. And the other thing I'll say, and I'll admit this freely, is we also don't know. I'll get asked questions sometimes from investors, but they don't usually go here. Sometimes board members or even members of our own management team will say like, where do you think interest rates will be? Or what do you think the Fed will do? And it turns out if I knew the answer to those questions, I would do a different job. It would be much better and I'd probably make more money. And I don't know, maybe I'd still be stressed, but I probably wouldn't work as many hours as I am right now. So I actually don't know. And if we're being honest, no one on my team knows. That's not our job. Our job is not to know exactly what the market is going to do. Our job is to plan for what the market gives us and make sure we're successful and we're providing the right transparency and insights and financials to our key stakeholders, being our management team, our board of directors, and our investors. So the way we build a forecast is sort of laying the foundation of, we know any forecast is likely more of a sensitivity analysis, right? We will always pick and choose a base case, but we will think really hard and we'll do a lot of math about what happens if XYZ happens. How do we perform? How do we pivot? How do we give insight to our business stakeholders in terms of what they might need to think about and do differently? So said differently, we scenario plan and we spend a ton of time on it. The other thing we do, and this might sound crazy to some of your listeners, is on a weekly basis, we reforecast the entire business every single week.
Every week?
Every single week, we've built financial models that allow us to do that. Now, that doesn't mean that we change the baseline, but it does mean we input a lot of the new market assumptions around rates and inventory and all those things. And we spit out an output that says, hey, based on what we know now, this is a more likely scenario of happening. That doesn't mean I necessarily change what I show to my board of directors or my management teams or investors, but I do want to see that information because movements in rates and movements in key KPIs that are macro driven do matter to my business. So we've built this really flexible and adaptable platform that allows us to do that. And I would say, I don't know what business, all your listeners are in, but generally speaking, more flexibility is better, right? No one says in finance, man, I wish we would I'd have less insight or less flexibility. Now, what you do with it, and who you show it to really matters, but we really pride ourselves on being able to do that because our business just moves so quickly. Every day matters.
How do you make sure that you don't have forecast fatigue? Because I've gone through periods of time where I'm trying to reforecast. I'm like, I'll just toggle that variable and not do the whole rebuild. Like I imagine that's a lot to prepare for each week.
It is true. And I don't know many good ways to do that, except for you have to invest in the automation, right? If you're still inputting every assumption yourself or your finance team, your FP&A team's doing that, if they're still making judgment calls on, making up expense ratios or leverage ratio, they're probably not you're going to run out of steam pretty quickly, particularly if you're trying to do it on a weekly, monthly, if not weekly basis. So we've really built it so the model can accept a lot of the macro things that we're really trying to isolate. And then a lot of the internal things like the fixed costs and stuff, that won't necessarily change on a weekly basis. But it is a real thing, which is why I kind of go back to, we do this exercise for us in the finance work. We don't necessarily share that with everyone in the business until it's time or we're ready to share it because of that thing. You also can't go to your business partners and say, the forecast has changed every week and your expense budgets change every week. That won't make for a very good finance partner. But you can go to your business partners and say, hey, did you know rates change? And I think there's an opportunity over here to help some consumers or to do some rate and term finances over here. And here's what I think your cost of acquisition is. And why don't you go out and see what you can do? That's the kind of insight they love. If you tell them their expense budget's cut or grows every week, that's a hard way to plan a business.
Well, it sounds like your finance team is more business consultants for lack of a better term.
Yeah, I like that description actually, and I might steal it. Thank you for that one too. We do pride ourselves on being good business partners. One thing, if you're on my team, you'll think this is a broken record, but we pride ourselves on we evaluate our work partly based on how our business partners evaluate us. And I think that's important. And I don't know, I haven't worked in every finance shop, but I think there's a part of certain finance organizations that think, hey, like we're the smartest people in the room kind of syndrome. And in a lot of cases, they might actually be. That's not necessarily wrong. But I think partnerships are based on trust and partnerships are based on relationships. And ultimately, the goals of the finance team and the business organizations are exactly the same, usually, right? Grow enterprise value, market share, profitability, whatever your kind of key KPIs are, you're both aiming to achieve them. And if you're not, you have a bigger problem you should talk about. So once you align on like what the objectives and KPIs are, the rest is a partnership and how to get there. I like your term business consultants because we call ourselves partners and we think about, I'll never do a performance evaluation of myself or anyone on my team without talking, if they're in like the FP&A org, for example, without talking to their business partner. Even though in some cases, yes, finance has to be the group that provides, we say good and bad information both must travel fast. We might have to have tough conversations or tell people things aren't working. Yes, but there's still a way to do that through trust and through the relationship. And I think if you do that really well, you set your company up for success.
I think it also underscores why it's so important for finance to be involved in the overall strategy, right? Not just reporting the numbers, but being in the guts of the business and understand where you're trying to point the thing.
It's such a good point. If I think about, for example, where I spend my time, that's the majority, frankly speaking. I've had a chance to listen to your guests, CJ, and I hear a similar theme, which I think is true, which is CFOs and finance folks are no longer just CFOs and finance folks. We kind of cut across the organization horizontally, right? We sort of dabble in COO roles or chief business officer roles or chief strategy. In fact, on my team, strategy and development group reports to me, as a matter of fact. It's not the case, I know, in all shops, but in our shop it is. And I think you have to be involved in that. And for what it's worth, if you're a finance professional out there, and you don't have a seat at the strategy table, or you're not getting the right information from the team leading the strategy, I think you're gonna have a tough go at it. I would ask to have a seat there, even if it's just observing, because you said it well, but without understanding the strategy, how can you develop the right KPIs? How can you develop the right financial metrics? How can you hold the business accountable and yourself and the company accountable to those metrics? I won't be surprised someday if there's really no difference between a CFO and a chief strategy officer. It's almost one thing. I don't think, it depends on the size of your business and, where you're at in terms of your growth stage. But generally speaking, I think you have to be willing to do both. The days of CFOs just being good treasurers or good finance people or good accountants or good tax professionals, yes, you should do all that and you should focus on that. But if you're only in it for that and you're at a big growing company, I think you're in the wrong seat. You have to be part of the strategy conversation. Sometimes you'll lead it, which is the case a lot of times at Rocket, but sometimes you just have to make sure you have a seat at the table so you can build the right financial models and give the business the right insights.
Brian, I'm going to take you into what we call our long ass lightning round. So the first question I ask every successful person, what's one thing you've messed up on the job before?
Only one? Where do I start? No. Yeah, it's a good question. So I think the thing that stands out to me the most is, so I've been in this role a little over 2 years. I've been at Rocket, I mentioned 11. I've had if you can name a finance role, I probably had it.
Mm-hmm.
I was lucky enough to bounce around, and I actually started in a business role before that too. So, but I would say I was so driven to the results, the business objectives and the financial results and the strategy, and earlier on in my career here at Rocket, that I actually forgot about, one of the most important parts which was the people in the team, and building the right team and surrounding myself with the right person. As I said earlier to you, which is so true, I'm not the best at any one of these things. And I'm probably not the best at even combining these things. But I now can tell you, which I couldn't tell you, a decade ago, that I think I'm also pretty good at building the right teams. I sort of thought I could just power through this, drive the right results, be a good business partner. But then you quickly realize, man, number one, you can't go at it alone. And I'd be silly. Why would I even think that? But number two, your team matters, and who you put in those seats matter. Just the one thing I'll say on that, just a quick principle thing from our team is we believe smaller teams are more effective than large teams, period. We believe that every new person you add, especially to a small team, either enhances that team or dilutes that team. There's no in between. There's no neutral. They're either making the team better or they're making the team worse. So treat every new person you add like they're the only person you're going to add, and invest in them the right way. While I can sit in front of you and say I do that now, maybe to some extent, I'm not perfect. I can tell you when I started my career, at least here, I didn't invest in that. And it really came back to burn me. You can't do it all yourself, and you definitely won't be the best in each one of those verticals.
People forget that each time you add somebody else, you're adding another node to the network, and they have a connection with every other node in the network. So it's a non-linear add.
It's so true. And by the way, I'll give you one more, CJ. Remember, finance teams are often the teams that have to tell business teams, I got to cut your budget, or you can't hire those people, or, God forbid, you can't even have all that headcount. You have to reduce headcount. Those are literally the worst conversations that no one needs to have. But I tell you one thing that makes them much, much more effective is if you hold yourself accountable to those same principles. So I will always be one of the smallest teams in the company, but I'll always strive to be one of the most effective teams of the company. Because how could I ask my business partners to do something that I'm not willing to do? You will be out of integrity way too fast.
Yeah, you can't be building your own fiefdoms and then telling other people that their teams need to be more efficient.
That doesn't go over well. Trust me. No. I'll add that to my what did I do wrong in the next podcast 2.0.
So if you could tell your younger self something knowing what you know today, what would you tell him?
I'd say slow down and enjoy the moment. Really appreciate the learnings that you get along the way. I think maybe this is true. I don't want to speculate for a lot of finance professionals, but we get so like part of what we do is like you work in the historical numbers and then you quickly go right to the projected numbers, right? Like it's like you get so excited when the actuals come in and then you spend about, 17 minutes on them. You're like, okay, but what about next quarter? What about next year? And you're always focused on that. So maybe it's part of the job. I don't know, but I know for myself, I have a tendency to just keep going and not appreciating the moment. You mentioned these public companies and things that we bought. These are huge moments. And I've done a lot of cool things here because I've got to be part of a good team, but slow down, appreciate it. And when you do have those opportunities, take those learnings, actually ingest them, think about them, and bring them to your next project for good or bad.
Yeah, I think we all find ourselves on a quarterly treadmill, and once they print, it's like on to the next.
It's so true. It's like what people say, like, well, what happened in Q2? I'm like, I don't know. It's Q4. What are you talking about? Q2? Where was that?
More of a technical one. Can you walk me through your finance software stack? What tools does your team use to get the job done today?
Sure. So we're a Workday shop. So that's our primary source. We use the adaptive planning model. We do, sprinkle in some other tools and insights. One thing I'll tell you right now, which is probably not a surprise to any of your listeners, is these AI tools for finance. If you're not using them, man, you're doing something wrong. I know, CJ, I've heard some of the advertisers on your network, and what a huge opportunity. The time to digest financial information or prepare things from ledgers or analyze information. Like if you're still doing it the old fashioned way, seriously, like challenge yourself, like to explore some of these tools. I think for us, some of the challenges is like, we are, like I said, we're a big, large cap public company. So we need to have enterprise tools that work well for us and serve our needs on a national scale. But some of these up and coming tools are competing with those very fastly, and they're very interesting. Just things around the preparation of the financial statements, the analyzing the ledger and closing of the books to, of course, on the forecasting side, even the stuff around some of the SEC stuff, if you're a public company, like preparing of 8Ks, filing of 10Qs, this stuff is going to be automated if it's not already. And if you haven't started, you make sure you have the right checks and balances and controls in place. Of course, CFOs actually have to sign those documents, PSA, but there's some really cool tools out that where we've been exploring over the past 18 months, I think are making our jobs better.
That's really refreshing to hear that your team is experimenting. Like a huge, large cap company like yours is willing to try some of the up and coming tools to see if you can get an edge and get some of that time back.
Well, it comes back to, we are a technology company at our core, and going back to your business partners, like, our business partners are being asked to use LLMs and AI and embrace the power of technology so that we stay ahead and don't fall behind. But as a finance team, we can't show up in a business meeting without embracing that same, type of technology in our world and getting to know it. You have to be, it's innovation or die. It really is. And I know finance professionals, rightfully so, myself included, are sometimes reluctant because we do need extra controls and protections. We have a fiduciary responsibility to do. But again, like part of what makes AI cool, at least in my world, is it can help on the accuracy front too. Frankly speaking, it is generally more accurate than just human beings doing human being things. You still need to double check it. You still have to make sure it works and get a sign off in most cases, but the stuff is really cool.
All right, this is a fun one. What have you learned working with Dan Gilbert, the guy behind Rocket, Cleveland Cavaliers, StockX, and Shinola?
Wow, this is a big one, but since we're in the lightning round, I'll try my best to keep it short because I've learned so much. I mean, honestly, I wouldn't be here without them, and I mean that. I was lucky in my earlier part of my career. If you don't mind, CJ, just one quick story. Sometimes,
please.
People will be like, they'll ask me like, how did I get to know Dan? Maybe you can take this tip if you're in a business like mine. Maybe you can't. I don't know, but I'll tell you one way. Just be available because if you're working with any entrepreneur, particularly someone as successful as Dan, multi-billionaire, majority owner of Rocket, you can do the math, but they're busy, right? And they don't work. I've worked with a lot of entrepreneurs. I don't think they ever work like regular hours. 9 to 5 is not like a thing. And if you're not in an entrepreneurial business and you want to be one day, you should go in eyes wide open. 9 to 5 is not a thing. But anyways, long story short, one of the first ways I got to know him was there were some things that we were a private company at the time, and we had to send out, I don't remember exactly what it was. I think we're doing something with rating agencies or something. And one of the things with Dan is he likes to review things, especially things that go out into the public or are going to represent the company. He wants to get his eyeballs on them, even today, rightfully so. But the problem was when you were going to get in there to review them. So you might get a meeting scheduled at 5:30. And I got it, cool. 5:30, I'll be there, no problem. Yeah. And so I worked this time I wasn't in this role. I was, I don't know, something in finance. I had a boss, then a CFO. But the problem was, he would work into the night a lot of times. And what would happen is first the CFO would peel off at 7:30, I got kids. I can't, what am I doing here? I got to get out of here. I already got a job. I'm fine. Right. And then I was working in the treasury team, and then the treasurer would peel off at 8:30. And it was just me, lone man there sitting outside his office on a laptop, trying to look busy. And eventually he'd get me in. And sometimes that would be 10 p.m. It'd be 10 p.m. and I'd be the only one left, last man standing. And I'd go over the documents with him. I'd probably be able to answer about 25% of his questions. On a good day, I wasn't in a senior enough role to totally get it. But I'll tell you what it did is it gave me FaceTime and it allowed me to build a relationship with him. And maybe he saw something, maybe he didn't. But guess what? Next time he had a question about one of those documents, he would call me, literally pick up the phone and call me, skip level down 3 levels to me, could have called my boss, my boss's boss, the CFO, but he knew I was there, I was available, and I'd have the answer. So part of it, CJ, it sounds cliche, just show up. Some people won't show up. Some people won't show up. They just won't. And yes, was that an annoying night? Yes, but the sort of brilliance I got out of those conversations, the amount of learnings I got, I don't know what he got, but I got out of that. And the cool thing about him is if you were in on one of those conversations, you'd end up talking about 25 other things. He'd ask me questions on the business. What am I seeing? And then I'd get to hear him talking about this business in a different way, or sometimes his other businesses in a different way. So part of it's just showing up. And then, one other thing, CJ, that comes to mind, and I'm sorry we're in a lightning round, but I should say it is,
no, go for it.
Fun fact, so to speak, fun story is we almost bought Yahoo back in the day. Now this is going
Yahoo.
Yahoo. Yes, it was crazy. So, we were always, if you could tell, we've always been an inquisitive company. So if things are sort of for sale that are interesting, we tend to look. We don't buy them all, but we tend to look, as you can tell. And sure enough, we got word about that. And we were private, so we weren't even a public company. And, he had to assemble a team to go out and evaluate the company and do it. And because I was in those late night conversations and I must have been a known commodity, I got a phone call from his assistant one day and, would you like to be part of the team on a confidential project? And I'm like, I think so. It's just okay, we're thinking about buying a company. I'm like, okay, cool. And then she's like, it's Yahoo. And I was like, what? It's what? And so anyways, to make a long story short, I got to be on the plane with him and make several trips out there and debrief afterwards and really dive into that business. Now, at the end of the day, he didn't buy it, which might have been one of the best decisions he's ever made. No offense to the company. Obviously, it ended up, at that time, I think it was Verizon, ended up in good hands, but obviously it looks a lot different than it did. But going back to your original question, the time is the most valuable piece with an entrepreneur like that, and someone who had found success, just to see how their brain ticks, just to see how the things they focus on, how they navigate their day, how they think about things. That's the invaluable lessons. And I know I wouldn't be here if it wasn't for Dan and him sort of taking me under his wing on those projects.
I love how you point out just showing up is 80% of life. And it sounds so simple, but it does unlock the next opportunity and then the next opportunity. It's almost like compound effort leads to things that you couldn't expect.
It's so true. And it's hard to quantify in the moment, but what's the downside? Yeah, it's one late night, 4 hours of your life, or one more Zoom call, or a weekend call. But to your point, you don't know what it ends up in, but it's probably not going to be bad.
Last one I got for you, more of a fun one. And if you don't have a good answer, we can always cut it. But what's the craziest thing you've ever had someone try to expense?
That's a good one. Well, we've had a lot of crazy parties, as you would expect. We've been very entrepreneurial. Getting team members together is like a big thing of ours. So I don't know if this is going to be the craziest one thing, but I will tell you the kind of after the meeting bar happy hours are probably some of the ones where you're just like adding it up and you're doing the math. You're like looking at it on a per person basis and you're like,
Yeah.
this feels impossible, right? Like, come on, how could you? And by the way, I hope everyone took an Uber home after
Yeah.
that. Most people are pretty responsible, but you do get those one-offs where it's like, come on. We have a big sales force at Rocket, and salespeople like to have fun, and we want them to have fun and burn a little steam too. But sometimes you're like, what's going on here?
Brian, this has been an absolute blast. Thank you so much for carving out time for us.
Great. CJ, it was great to see you. Thanks for inviting me to do this, and it's been a total blast for me too.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.